Platforms like Venmo or Zelle make it easy to send money, paying your friends back for dinner, receiving payments in your side hustle, all of that. So, of course, the IRS is now stepping in to take a closer look. Starting this year, users with accounts taking in more than $600 in payments will begin receiving tax forms. So what does that mean for you? Will you have to pay taxes on that money coming in? Garrett Watson is a senior policy analyst at the Tax Foundation, where he's an expert in federal and state tax policy. Garrett, welcome to Quicktake. There's a lot of misconceptions out there, so clear some of them up for us. The IRS does not care about my friend paying me back for her share of the hotel room we got last weekend, but it does care if another friend is paying me for an apartment that I rent out on Airbnb, right?
That's right. I mean, the bottom line here with these reporting changes is it's changing what information the IRS has, but it doesn't change your tax situation. So if you are engaging in transactions on Venmo or elsewhere, like on PayPal, you're paying someone back and it's not a taxable transaction, you have nothing to worry about. If you're running a business where there's income that might be taxed, this is another place for you to see where that information is being reported, another place for the IRS to see it. And in that situation, you want to make sure you're paying your taxes properly.
Okay, you mentioned taxable transaction. What does that really mean, though? I mean, how will the platform, how will Venmo or Zelle be able to tell what's a taxable transaction, what's not?
So what platforms like Venmo and Zelle are doing is they're just reporting all of the gross transactions that are happening on their platform. That could be if you're running a business and that income could be taxed, or it could be something as simple as paying back a friend for dinner. But what you have to know is that this is just changing what information is being reported to the IRS. And it's really up to you when you're reporting on your tax forms to determine whether or not that income is subject to tax. So in the case of being a small business, say you're collecting your revenue through PayPal or through Venmo, you may want to take that income and ensure that you are properly deducting expenses and that you're paying taxes on that net income. But if you're in a situation where you're paying back a friend or using it to give a gift to someone, you don't have to worry about that amount being reported on a form. It's not considered taxable income, so you don't have to report it on your tax forms.
Got it. But nevertheless, the platforms will send the report anyway to the IRS, and whether you follow up is basically your call based on whether you run a business or not and are making income off of those transactions. Can't businesses just change their accounts to individual accounts and call their vendors and customers, friends, and family?
Yeah, there definitely is still going to be opportunities for folks who are not interested in complying with tax law to try to get underneath this limit of $600 in order to or to mischaracterize the nature of these transactions. But the point of this change in the rule, which happened beginning this year, is to provide the IRS more information to identify places where folks could be doing that, mischaracterizing their transactions. And so that's just more reason to be complying with tax law and following the best practices when running a business. But if you're in a situation where you are already paying taxes on your income and doing things above board, this reporting change is not anything to be worried about.
So the threshold for everyone to watch out here is $600, and that's total transactions over 1 year. So it's not like you can break up $600 into 10 transactions of $60 each. The limit used to be $20,000 over 200 transactions. Why did it change to such a small amount?
Well, what we found originally was because that transaction threshold before was really high, 200 transactions or $20,000, a lot of folks who might be engaging in side hustles or in more informal activity using these platforms weren't getting any forms from the IRS, and the IRS wasn't getting that information themselves. And so that led to both confusion potentially for folks who didn't know potentially how much income they earned on those platforms, and it did not create transparency for the IRS, who may not have known whether or not these transactions were occurring. And so when they lowered this threshold to $600, a much larger group of folks, including folks who really don't owe any taxes on some of these transactions, are captured in this reporting. And I think that's what's generating a lot of this misinformation that's out there about whether or not particular transactions are taxed. Really important to highlight that this is not a change in tax law, it's just a change in what's being reported.
Okay. I see what you're getting at. Nevertheless, people on social media are just outraged that small business owners are getting taxed or at least being scrutinized when you've got big businesses getting to keep the tax cuts that was pushed through by the Trump administration. And ironically, this new lower limit of $600 is part of the American Rescue Plan that was passed by the White House, the Biden administration last year. Is that correct?
That's right, and it's part of a much larger discussion about what is the best use for this information on the IRS, as well as the broader discussion about resourcing for the IRS and compliance. As you highlighted, there's been a lot of discussion about trying to ensure there's higher compliance for higher earners and for corporations. But this change really is going to get at folks who are participating in the gig economy, who are earning between $600 and $20,000. Though it's worth mentioning that this can have some benefit for those folks in that they may also receive this form from the IRS. So that will give them some more transparency on what they could potentially be owing or what's being reported to the IRS as a transaction.
Also, it gives them a fresh way to look at perhaps where they might be able to take deductions on some of their business expenses and reduce their taxable income. The IRS is not in great shape. I mean, they don't have enough funding. They don't have enough resources. How likely is it that small business owners would be audited if they decided to ignore this tax form that gets sent from Venmo?
So the likelihood of being audited overall, especially if you're not a very high earner, remains pretty low, and it still remains low even after this reporting change because the IRS has seen their audit rates go down over the last 10 years. And so if you are in a situation where you're receiving this form, say for personal reasons, and you're worried about being audited on that, it's probably not a high risk, not something to worry about. If you are worried and you want to mitigate any potential risk, having information on hand on the nature of those transactions is always really helpful. A really good example of that is, for example, if you're taking a rent payment on behalf of a roommate and relaying it to your landlord, that could add up to north of $10,000 a year. But that's pretty straightforward situation where you can keep those records. If you're a small business owner, of course, I think it just underscores the importance of just maintaining the best practices of your business, right? Separating out your business and personal accounts, keeping receipts if you're making deductions. Those are things you should already be doing, but this reporting change just makes that more important because it might highlight some of these potential issue areas if you're not doing that to the IRS.
Okay, so keep good records is your advice here. So I have to admit, Garrett, when I first saw this news, my first thought was drug dealers are all going to move back to cash or crypto. I mean, they're going to run away from these different platforms.
Yeah, I think there is going to be, as a trade-off to this, some incentive for folks who are not above board on their transactions to move away from these platforms, and that is going to be one thing that the IRS and Treasury will have to monitor if there are other ways to try to get at those types of transactions. There's already, of course, monitoring in the financial system for illicit activity, and there might be a bit more of that as a trade-off of trying to be a bit more transparent with these digital platforms. And so that will have to be part of, and that really shows that this is a holistic discussion, right? You can try to plug one hole in reporting in the tax system, but that will create behaviors that show up elsewhere in crypto and elsewhere in the financial system. So that is an important consideration as policymakers think of next steps on reporting.
Yeah, absolutely. Everyone in fintech likes to talk about how the future is cashless. Cash will soon become obsolete. We're all going to be like Sweden. But it's policy changes like the one that we're dealing with right now that will keep cash really more popular than ever. The thinking is that cash transactions are non-taxable and therefore, or I should say that they're non-traceable and therefore not taxable. How would you respond to that?
Right. So in the tax system, generally speaking, the nature of how you pay a transaction or try to work with folks financially, it has no bearing on whether or not a transaction is taxable. So if you're taking cash for particular for revenue somewhere, that income may still be just as taxable as if you took it digitally. And while it's true that cash can have there can be some challenges for folks to trace that, if it does have any interaction in the financial system, if you put that cash into a checking account or withdraw it elsewhere, there will be records that tie that cash to you. So unless you're in an operation that's fairly sophisticated, there's still going to be a lot of risk in doing it that way. Best practice is to remain above board and report the cash stuff that you are getting, be it tips or other forms of revenue.
Garrett, great stuff. Thank you so much. Really appreciate it. Garrett Watson joining us from the Tax Foundation. A lot to think about come tax filing season. Of course, it does not apply for 2021 taxes. It only applies to 2022 taxes. So this is something we'll all be dealing with in April of 2023. This is Bloomberg Quicktake. I'm Scarlett Foe.